foggy and rainy. It's still a Sunday morning, so I'm very happy to see such a nice crowd here. But first of all, my name is George Zuberi from IMPA, and this is the third of our mini courses at this Research in Options Rio 2017. This time, the mini course is going to be delivered by Professor Alvaro Cartea from the University of Oxford. It's the first time that Alvaro comes to Rio, and I'm sure it's going to be the first of many other times. Professor Cartea is one of the main specialists in the area of mathematical finance and commodities, and today he's going to talk to us about commodities. So Alvaro, thank you very much for being here.
Thank you very much, George. Yeah, clearly it's wonderful to be in Rio. It's an unbeatable place, I have to say. So when I heard that I was teaching a mini course, right, I asked Sebastian, whom you had yesterday, because he's done it many times, but whenever I see his slides, I get scared, right? So he does like 300 slides in 2 hours. So I'll be much more gentle to compensate for my friend's sort of pace. So I will truly try and, assume without patronizing anybody that is, you haven't really done much stuff on commodities. So I'll do a little bit of the basics, a little bit of the basic jargon, and then I'll move on to a couple of models in power and gas. And I'm very happy to take questions as we move along. Most of what I'll be doing will be based on continuous time finance, but I think I have too many slides for 3 hours. But if I have to jump any of those, I will, just to show you a classic equilibrium model of power prices, which I think is kind of a seminal paper in power. And it's very, it's in a static setting, and it's quite simple, really, however, very insightful. But let me just get going with a couple of things. Some of the slides are old, but I just could not update it because I used some sources which I forget, and I'll tell you in a moment. So what is the thing about commodities that makes it different from the rest of the assets, right? Well, first of all, they're not financial assets, as we all know, and I think Brazil and Southern America is one of the places that exports commodities to the rest of the world. Commodities are to be consumed, right? It's not a financial, it's not a piece of paper that derives its value from, company's value and so on. It's something that you just buy, use it as an input, you consume or you sell it. So, for example, if you compare it to stocks or bonds, you normally have that, these will produce a yield or a dividend flow or some sort of payment at the end of it. However, commodities will generate a stream of benefits, which are very difficult to measure, right? One of the things that I find funny about commodities, if you look at the literature, how it's developed, a lot of the things you see sound like fudge factors. Like, you can't really explain something, so you just plonk in a new sort of process or parameter to be able to make prices match. And you'll see, I'll come to that in a minute. And also, there's some costs, okay? The problem with the commodities is when you hold it, it might be very costly to just keep it or put it in a warehouse or leave it underground. So those things alone make it very difficult to sort of model, or quite different from financial assets. And some of the extreme cases I'll show you and I'll spend some time on is on power prices. You can't store power, or it's very expensive to store. And then, things become very extreme. I'm just going to give you a couple of examples. I know Brazil has tapioca, right? But plenty of that. So, when you look at the sort of things that get traded and been traded for centuries, right? Kind of odd things like urea and the CME and corn and so on. But, as you look at the historical sort of process of all these things, there's plenty of weird things that still get traded that, well, perhaps I was not even aware of. Exchanges, there's tons of exchanges, right? I've given this talk a few times, and I've taught a commodities course, long versions and short versions over the years, and every time I have to update the slide, I look at what's happened. I mean, I just can't keep track of how many have merged with each other and so on, but hopefully, this is kind of just a very small subset of places in the world where you can still trade commodities. These will be open outcry markets. Most of them are becoming electronic, so they're becoming much more interesting. I'll be very happy to talk to people later on over the break about algo trading and commodities. I will not be talking about that today. We have the Brazilian Mercantile Futures Exchange. The sort of London Metal Exchange is one of the oldest in the world, for metal. And in Asia you have also, but there's hundreds around the world, and some of these specialize in different products. And one very famous one, the oil WTI. I just wanted this example to show you how things are. One has to watch out when you model something, right? So, for example, if I were to buy, be long WTI, what does that mean? Well, first of all, you need to understand the nature of how these contracts are traded. So one of the important things is each market that I showed there, all of these exchanges, will have products, and these are kind of standardized products. When you go to the exchange, they're standardized, and they're not kind of the simple, I buy one of this. So if you want to buy oil, you just buy a contract, and the contract is for 1,000 barrels, and let's say if a barrel costs $60 per barrel, I don't know what today the sort of oil is doing, but it's peaked at 150 a few years back, and it's just taken a dive. And of course, it's the one type of oil. Then if you were to sort of go along this contract, you end up being long, something of the notional value of $60,000. However, you didn't have to put up all of the money up front, okay? Because this is kind of, it's like buying a forward. This will be delivered to you at some point in the future. So all you are to, you're asked to perhaps post some collateral, around 5.6%. And however, you do have the ability, or you have the choice of only collateralizing a little bit of it. This is the minimum requirement. You can fully collateralize the entire position, right? So if you try and see the value of a position, you have to watch out what is it that you do. Sometimes, depending on what the risk-free rate is doing, you might be happy to fully collateralize the entire position just to make the interest rate. Let me give you, some of these. Again, I can't remember the source. It's a book. I have to check, but I just realized when I came here that I didn't look at on my shelves. But some of these have been trading for a long time, and there's many more, as I said, and some of these have started a very long time ago, and then they merged, and now they're part of ICE. And again, this is just a very, very small subset of what you can buy. And if you come to think about it, traditionally, perhaps these things have been traded for much longer than equity, for example, right? Because there's always been a need to sort of go, and trade inputs to produce stuff. So one word of warning again is how do you measure the performance of all of these contracts? I'm not going to get too much into it, but there's a nice paper that Bess and Binder just put out not too long ago that shows you the fallacy of rolling over contracts. I will not be touching upon that, but I'll be happy to direct you later on as to what does it mean to buy a contract. The rolling over I'll discuss a little bit later on, but it's important to understand, how is it that people make money by sort of buying a long-dated forward contract, and before it expires, you dispose of it and buy it again, but depends on what the curve is doing, whether you make money or not, right? Let me show you again something which unfortunately doesn't go, stopped in 2007, which is, okay, what is this thing about commodities? So many of you are too young to have gone through this, but in the early 2000s, people thought about commodities as a safe asset or a safe investment, not as a safe investment if you wanted to protect yourself against inflation, right? It wasn't clear whether that was true, or if you look at the historical performance, you can kind of see. I think I have a CPI adjusted one later on. So if you take, quite a few years and put some money on all of these or a portfolio, you see the Sharpe ratio of the entire portfolio will be like 0.51, and the returns, of course, some of them will be negative. But if I were to repeat this and do oil, it might be completely different. So the second question that people were interested in, I'm still interested in, is if I diversify my portfolio by sort of going investing in commodities, do I span, my investment in a better direction? You would love to, if you have a well-diversified portfolio and I offer you another asset that can actually sort of push the sort of Sharpe ratio to the right, or if you look at your investment boundary, you would like that. And I'll show you a little bit of, I don't have such a study, but I'll show you where do people think that could be the case. So again, if I look at equally weighted portfolios from one of these commodities, so I invest some money, equally weighted, and just let the time go, and adjusted by the CPI, by inflation, then you can see that the real return is there, right? It's not a hell of a lot. It doesn't sound like, if you wanted to protect yourself against inflation, this was the best. It would be nice to have some sort of index-linked bonds or some of these that protect you against inflation to see if you had better protection by entering into those sort of bonds that governments like to issue, which is, you give me money and I just will guarantee that I will give you a return over and above that will beat the inflation rate. So this is one where you might think, okay, is it true again, that this is from 62 to 2007. By having commodities in my portfolio, do I gain anything? And well, by looking at the correlation of these different ones, like commodities with the S&P 500 or a bond, you might sort of start thinking that perhaps you could include in your portfolio. Again, there's a lot of literature since on financialization of commodities, which tells you, what's happened, and when people just get on this bandwagon and start investing in commodities, you might end up changing the nature of these correlations. So I'm pretty sure if you were to do this again, and investment in commodities has become a lot more popular in the past, these correlations would have changed, right? Obviously, people start pushing because they think that, putting that in your portfolio will give you a better performance. When you look at the Sharpe ratios or the trade-off between the returns in your portfolio and the standard deviation of the portfolio, you might, if everybody thinks like that, well, in equilibrium, you'll end up being in a world where perhaps, this correlation matrix changes. So, again, this is kind of introductory stuff I want to give. This is, again, a little bit, what I have here is a little bit of jargon, which I don't use much of, but if you are interested in the literature, you'll see a lot of this stuff. Okay, so I don't know how many of you, and again, I presume some people know about this, but since it's a mini course, I want to just go over some of the basics. Contango and backwardation pretty much refers to the shape of the forward curve, right? So in very simple way, so imagine, FT here represents a forward written at time t, delivery at time big T, on some storable commodity ST, right? For the time being, I'm writing storable because of the story I'm going to tell you. Then I'm going to switch to power, where you can't really store it economically. So first lie, so one of the things about my lecture is I'll be telling you things that we have done, or the literature, or you can find in the literature, but I will also tell you what are the things which are wrong, or big assumptions that if you're not told, it'll be very difficult when you get into a paper and just think that things work that way. It is normally not the case that forward contracts are for point delivery, okay? So I'm thinking here as if, at time little t, I can enter into a forward contract that at some time in the future, I do a transaction. Well, normally, if you look at gas, oil, power, and, these for sure will never be point delivery. They normally express a delivery period and what happens. So let me just give you a simple example of what you might encounter. So, you see this in gas, you see it in electricity. Let's say that's time t. Right? So normally, whenever you think about a forward contract in power or gas, you enter into a contract today that specifies a delivery period. Okay, so it's just not point delivery. So this could be weeks, this could be months, or this could be 24 hours, or this could be a whole year, or this could be 10 years, right? So that already makes things quite different, even if it's a week. Okay, so these contracts normally say, well, at time t, we agree on a price, and you sort of deliver a commodity. You start delivering the commodity at time t1, and you stop at t2. Okay? Most of these contracts, again, will specify how delivery takes place, where does it take place, okay? And how much do you get every single day or every single hour. It's not the same thing to receive power from 7 to 8 in the morning than from 2 to 3 in the morning, right? These are completely two different animals in there when you look at this. You know, no one is interested, well, you're not as interested in power at 5 in the morning as you are at 7, 8 in the morning when people wake up. Well, clearly not on a Sunday morning, but, okay? So I'll give you plenty of examples later on. With power, gas, exactly the same. So many of these commodities, they're you know, when you hear spot prices in gas or spot prices of this or the spot oil, they're normally the shortest term you can find in the market, right? There's no such thing as a spot price for electricity or spot for gas. You know, the maximum you can do is day ahead or a few hours ahead of time. So, you know, there's misuse of language, but once you see that, okay, that's what they mean, it doesn't really matter. So in here, this is, okay, just a proxy, perhaps for a delivery, or you might want to think of just the sum of each one of these summed up, okay? So I just want to make sure that I'm not lying to you, but what I want to get at is something you know, here's quite a lot in the literature, which is the convenience yield, right? So the question, you know, let me ask a very simple question, which is the following. Imagine IBM. Okay, so now I'm going to go back to an equity. Today is trading at $100 per share, right? And that's time t. And I want to enter into a forward contract that, you know, someone will deliver 1 share at time big T, and how much money should I give, right? This is kind of the typical forward. So, you know, how much money should I pay to receive 100, you know, a share that today costs 100, right? So we all know, and I'm assuming everybody here has priced a forward on equity, and it's quite clear that if IBM doesn't pay any dividends in between and the risk-free rate is 5%, let's say you end up saying, okay, really, I take 100, and then let's say I gross it up. By the risk-free rate, let's assume the risk-free rate is constant and so on. So by no arbitrage, you can compute something very precise and say, well, you know, anybody who deviates from that, I've made a couple of assumptions. This is the price. Well, commodities is quite not the case. Imagine you want to buy a herd of cows, okay, in the future. How would you price that? Okay? So imagine today, someone says, well, I want to deliver a cow to you. What price do we agree on? So a cow will be costly to keep, right? If you want to set up an arbitrage argument, you can say, okay, because this one is based on, I borrow money from the bank. You know, the arbitrage would work. I borrow $100 from the bank, buy the share today, deliver at time big T, collect the money, and pay the bank back. Anything that deviates from this, you know, you can arbitrage. Okay? Or if it's depending on the inequality, you can say, well, I short the share, take the $100, put it in the bank, and then, you know, anything that deviates greater or smaller than this price, you can arbitrage. Well, let's try and do the same thing for a commodity. You say, well, I want to buy a cow today, deliver that in a year's time or 6 months' time. You know, what is the price? So it is not straightforward because, you know, you have to buy the commodity, you have to store it. In this case, you have to keep the cow alive. So you have some storage costs. Well, clearly, that's a bit of a problem. But the convenience yield is what I call a fudge factor, but it's very intuitive. The convenience yield is how much do you derive in terms of, you know, you can call it utility or you can put some price to it, but you derive something. The cow is a good example because if you're milking the cow every day, you know, you do pick up costs of housing this cow and keeping it alive and so on, but you also derive a stream of cash that comes from having the cow and producing milk. So that's kind of a very straightforward way of thinking of convenience yield. But when you look at data, sometimes it's not, you can't really map one-to-one. A cow gives me milk that I sell on the market. You can also think about convenience yield in the following way, kind of a more subtle one, but it's exactly the same thing. Let's say you have a painting, okay, and you agree to deliver the painting in a year's time. How would you price that? Well, we know the sort of market today is kind of wild, right? But imagine it's a painting that you want to write a forward contract on a painting and you will deliver in a year's time. So first of all, this is not a traded commodity that you can short it or a piece of paper. So, well, how does it work? Well, I can go through the same argument of what is the convenience yield? Well, while you hold the painting and you derive utility from seeing that painting hanging on your wall, you can also think as if you're deriving something convenient from holding the painting. Okay? And you will see this convenience yield factor is a very important one that allows you to match prices in the forward market to the spot market. And that's, sounds like a fudge factor, but well, that's the one way in which you can, it's very difficult for anybody to say how much I value the painting. But in equilibrium, there is a price. If you look at commodities which might be strategic, you have kind of the same thing. You say, I observe a forward price which seems too far off from what the spot is trading today. And you might not be able to attribute this sort of difference. So imagine the spot that's the spot today, and at some time in the future, you ask yourself, the forward is some really far up or really far down. Okay? And you say, why is that? Well, it has to be a combination of the costs to sort of hold this thing and keep it alive or keep it in shape, but also how convenient it is to hold it. Oil, for example, the part of the convenient thing of having oil, but having the commodity yourself and not a forward contract, is that if anything goes wrong, some war breaks out in the Middle East and so on, it is convenient to have it in your background. So some players, or in equilibrium in the market, you will see convenience yield by, just picking up the value you attach or the holder attaches to having this thing in the ground, right? I'm not talking here about credit risk that when you get there, people will not give it to you, but it's, you want to have it and you derive some sort of value from that. Okay, so in here, the way I've written it then is, okay, convenience yield can be, if I were to buy the commodity, and that's why I wrote storable, okay, because, I'll spend a lot of time doing power, which is, I think, one of the most interesting commodities in terms of mathematical behavior and challenging as well. I buy the commodity today, and then, I build up its cost by looking at, borrowing money to buy the commodity, and then the convenience yield, and then I might want to break the convenience yield. So you can see this skinned in different ways in the literature, but you might think of the convenience yield as a combination of storage costs, so you can think that of as always being positive, okay, and cost of carry costs, and then the convenience or the benefits you derive from having it, right? So the convenience yield, you can think of it as a combination of how much it costs you to sort of house it, or warehouse this commodity, or keep it, and how much, how convenient it is. I don't know, many years ago, there was a guy who had sold in an auction a Picasso. It was a famous Picasso because it had it was kind of a sexual Picasso. The shape, if you looked at it, some of the things would stand out. And I remember it was, this guy had it in Vegas. So I think he was a big party man. And before delivering it, he threw a party to celebrate however many million he got for that, and they just ripped a Picasso in it. So I'll try and look on Google, but that's quite a while ago, right? So this, C component is quite important, right? You have to really look after the commodity. So the convenience yield, again, you can break it up into the benefits. Okay, that's why it comes in with a negative, because it's like a dividend payment. Okay, so if you want to map one-to-one to equity, you can think of the convenience yield as sort of a dividend yield, right? Together, and you can bunch up the costs with the risk-free rate if you want it, but this is kind of a flow, right? So it's very easy to explain to someone that if you have, the sort of dynamics of the equity price, but the company's paying a continuous dividend or is paying dividends every time there's a dividend payment, the company has less cash, so the value of the company drops. Therefore, the stock price has to adjust by exactly the same amount, okay? But there you can see it, right? There's no mystery. If it's an announced payment and we know how much the company is going to pay out, the dividend payment drops the value of the stock at the time of the dividend payment. For the sort of shareholder, it doesn't matter because you either hold the equity that's worth 100 after the dividend payment might drop to 90, but you have 10 in your pocket, right? So as a shareholder, you are receiving the dividend, but this, that's why the convenience yield comes in, with a negative payment. So what is contango? Okay, and why is this important, right? So you can see, if you read the Financial Times or the financial paper, I don't know which one here in Brazil, and you look at commodities, an important thing is always contango and backwardation. I'm not going to get too much into the discussion of why it holds and so on, but I think it's important that I square away a little bit of the jargon. So contango in its sort of simplest form, some people take into account, strong backwardation or take into account the risk-free rate. But so long, when you see the forward price trading above the spot, like this picture here will be the market is in contango. If you see the spot trading above the forward price, the market is in backwardation. Okay? One tends to think that backwardation is pretty much the normal state. But it is not true. When you start looking at data, you will see that oil markets tend to be in the long term in backwardation, but in the short term they might be in contango. And gas, I have a couple of old pictures I have from a paper I wrote a while ago where you see that it could be in contango and then backwardation, and that shows many things about the market, right? Because after all, it's all demand and supply. Of course, convenience yield will be an important way to explain all of these things, okay? Why is it important? Again, I will not get too much into that, and I can refer people to the paper by Binder and Lemon. I mean by Binder alone. Imagine I'm just plotting here. Let's just write it as T, right? And the market looks something like this, okay? And this is the forward curve, right? So this is the forward, and that's time t. So if I look today, the market might be in contango for a little while, then goes in backwardation. So a strategy that relies on rolling over your exposure that can make money is one, for example, that is kind of very natural, and people do it over and over again, and it's this thing. So I showed you a continuous line, but normally these are discrete, lumpy things, right? When you go to the market, you won't find, for each point in the future, you will not find. So you might really have something that's like this, or like this, and here you have something like this, like this, like this. You have a few contracts out there, right? So if you believe, and this is a super important assumption, if you believe that across time, because this is a snapshot of today's market, if you believe that the long-dated contracts will remain backward-dated, well, you can buy this contract, time goes by, this contract goes up the curve, right? So if it's, let's say there's a year out, 12 months out, you know that if you buy this contract or engage into this contract, you wait for a month, okay, then sell it here and buy it again, and you always repeat that, you can make money. But it is not true so long as the shape and the level has to remain the same, which is not the case, right? So, even that simple exercise is one would say, okay, for me to roll over, and the rolling over is, you get into this contract, when you get here, you roll it back, you sell it and buy the long-dated one again, and you keep on doing well. But if this is shifting up and down, or the market can change direction all of a sudden, well, you might get caught into a really bad strategy. So again, there's plenty of examples out there in the literature of people who have gone bust because they were, they were somewhere here at the peak because, let me just make a side comment, right? When I learned mathematical finance in the late 90s, I always was taught, this is the spot price, and this is all you can do. Mathematical finance has changed dramatically over the last 5-10 years, I would say. Now everybody does worry about liquidity. Everybody worries about a limit order book being there. Everybody worries about, well, is it true that when I want to exercise, so do something, can I do it, right? Yeah? So you have to watch out that, these ones here in a backward-dated market, very long-dated ones, tend to be very liquid contracts. So you have to watch out, okay? It might be that what you're seeing is the midpoint, but when you go and buy and sell and do sort of this rollover that you buy, you go long that contract, and then you want to short it and go along the other one, the bid-ask spread really kills your rollover, right? So you have to really watch out. Or the moment you try and sort of access that price, the market moves away from you. So it might be, I'm just making that comment because people would say, well, it would be odd for that market that is long dated and backward dated around here to all of a sudden just flip up. But it might be too illiquid. So you might be really on the sort of knife's edge doing that rollover strategy here, right? You just don't want to all of a sudden go into this peak and be in trouble. But you might be forced to be around here because markets are much more liquid than the ones there, right? So, you can derive a little bit of inequalities. So in a contango market, you would expect that this is the case. Again, I'm assuming that the benefits is a positive and the cost of carry is also positive. The backwardation, I can also say something about the slope of the curve. I can look at the long-dated contracts, and you can have some arbitrage. If things get out of whack, you can arbitrage the market. And how does it get out of whack? Well, you know what the cost of carry is. Well, you should know more or less, which is not true, right? Again, commodities, all of this stuff is never true because these are markets with fewer players than the traditional equity markets. The cost of carry is a notion that you can't really go and Google how much does it cost to do this, right? Let me give you a simple example. If you go and buy gas and you store it, right, the prices to store the gas are kind of fuzzy, right? You might have to get into an auction. It might be that all storage is contracted out in the long term, right? So it's not very easy to say how much does it cost me to store, although at least I know the UK example much better than I don't know Brazil where you have the storage, but in the UK you should be able to check how much, does it cost you to store gas in some storage capacity, right? But whether you can exercise it or not is a weird thing, because I don't have to do that, but I did a whole paper. It was a funny paper. I did it with a student of mine who went to BP to work, and they did not allow us to publish the paper in the end. Because in the paper we were showing that the prices of storage in the UK were highly, highly undervalued, right? That if you really checked what the storage costs were, it didn't make any sense to see the sort of prices you were seeing in the gas market. So there's a question there?
Yeah, I think it's a place where theory and practice match only in theory.
Sorry?
I say it's a place where theory and practice match only in theory.
Yeah, I agree.
The number of squeeze stories, the physical traders in Chicago, etc., on oil and gas, where they see Amaranth, this hedge fund was, as soon as they see that someone is trying to arbitrage the physical, then you get a group of traders who will mean to buy all the possible storage capacity and then selling for low price.
Yeah, and all has to do with is a very small market, as you say. Very few players can actually change the course of action and course of prices. There's a lot of horror stories. If you look at the London Metal Exchange, well, let me just preempt this with a sort of longer comment. If you want to get into commodities, knowing the mathematics is as important as knowing someone in the field doing the stuff that you can always call and say, is this like this? Or how do I do this, right? It is not clear. So similar example to yours, I just, haven't been up to date for a long time, but if you go to the London Metal Exchange and see how things are traded, well, the metal is put in a warehouse, okay? And there's many around the world, and it turned out that Goldman Sachs own these things. Anybody here working for Goldman Sachs? Okay, I'm on record, but let me just say what goes on. So when you want to go along the commodity, they'll store it immediately. But if you want to sort of short it, they might take a year to take it out of the storage. So the in friction is minimal, the out is huge. And they charge you as well for storing it. And I don't know where did that end up, but Goldman's was being sued a few years back, big time, for billions for that sort of weird behavior. I didn't keep up with the discussion because I moved on to different things. But again, it's commodities it is supply and demand rule the game, but it's very easy for people to sort of tamper with demand and supply very quickly. Okay, so let me start switching gears a little bit. Let me show you a little bit of a few models, right? I don't know how we're doing with time, but
You have until 11:30.
11:30. Well, it's 10, half past 11.
We're going to have a break,
Yeah,
half
okay.
an hour, and then we start at 12.
12. Okay, fine. So I'm doing okay. So this will be okay. So I've just given you a little bit of background, contango, backwardation, and so now I want to say a few words about a couple of models. There's plenty of models out there, right? But I just want you to see how the literature has developed and what things people have done, right? So this is perhaps one of the first papers out there by Eduardo Schwartz. I think it was 97, right? So it was not too long ago. Of course, there's more literature than this, okay? Don't get me wrong. There's a lot of literature on storage. Okay, one of the first papers on storage is in the 1950s, by Brennan, but it's not the Brennan from UCLA, it's another Brennan. So it's funny because, I asked him, were you in your nappies writing papers, right? No, it was someone else. So this has been going on for a long time. There were many papers in the 80s on equilibrium models, but continuous time models were developed much later in the game, and I think this is one of the early ones. So this is in a paper by Eduardo Schwartz in his address to the American Finance Association. This is in the JF. He goes through a different load of papers. Let me tell you why. I know Eduardo quite well, but I've never asked him why he did it like this. But I tell you the way you need to think about this, okay? So what, again, makes commodities substantially or considerably different from equity? Well, equity, when you see prices, they can wander off quite high, right? So if I were to say, okay, let's take Apple, a random walk, people will say, oh yeah, that's a sensible path, yeah? Or, that's also a sensible path, right? And the company's not doing well. However, commodities, as I said at the beginning, is about buying. The ultimate goal is to use it as an input or consume it, right? So here, demand and supply play a big role, especially in the medium-long term. If you see a commodity kind of spiking like this, it might incentivize people to produce a little bit more, and that'll bring the price down. So all I'm trying to convey here is that we have to have a notion of demand and supply across time, okay? And there's two things that are important. There's two sort of time scales which really matter here. On the long-term scale, production will adjust to what's going on, right? If production, is under a lot of pressure, eventually things will happen to increase supply. It might be that it takes years or 6 months or, so that's a kind of long time scale. The short time scale is also that if for a reason demand is outstripping supply, it might be very difficult to actually have production react and increase, right? So for whatever reason, prices, demand shifts to the right, it'll be very difficult in the short term to react and sort of increase supply. So that's where you see price spikes. But the important message is, whatever time scale we're looking at, there's always some mean reversion in all of these prices you end up seeing. That's the one thing that you hardly see in equity, right? Okay? Equity, if I told you there's mean reversion in IBM, you would arbitrage that immediately, right? People would say, well, what is a mean reverting level? So, I would never buy above it, or I would never, sell below it, right? So that would defeat the purpose. Here again, although there might be sort of a mean reverting level, which is given by demand and supply sort of in normal circumstances crossing, you can still see deviations from it. And that, I think, is, what number one in a very subtle way captures. SDE1 is just saying, well, the spot, that's the price of the commodity, okay? I'm not getting into conveniency or anything just yet. And if you think of it, this is like saying that you will be reverting to some sort of price in the future, right, at that exponential speed. That's all this is saying. Of course, there's a lot more stuff. Later on, I'll be sort of, improving a little bit on Eduardo's, and I'll give you an example, and again, I'll tell you all of the bad things about all of those models that I've written myself and that people have written, and it's not that we don't know about it. It's, as anything, this literature has been organically growing since since Eduardo's paper for quite a while, where people have been adding different things and capturing different stylized features of the commodities they're looking at. So, I just want to go again. I'm not going to do all of these steps, because this is sort of a mini course, and I don't want to patronize anybody. You can think of it, okay, let's think of the log price rather than the level itself. If you're interested in returns, and you can solve, I didn't compile this well, you can solve that SDE, and all I want to say is, well, what is the price of a forward contract here? Okay, so you will see in the literature many ways in which people do this, right? I'll give you some which, okay, I look for an equivalent martingale measure, or I do a risk-adjusted process, which is, okay, there's some risk in this. So this is exactly what I end up doing here. I say, well, my change of measure really is given by some sort of market price of risk. Whenever you see lambda, you can, if you want, think of it, although I change my notation a little bit later on, as something, as Sharpe Ratios if you want, so I normalize it by sigma, if I don't, it doesn't really matter. So under some sort of equivalent martingale measure, this is trivial, you just say, well, this is the risk-adjusted process, and then you can price a forward. This is a really simple way of doing it, but it makes really strong assumptions about not only what the sort of pricing measure is, but what the forward contract will end up being. Okay? And this is a recurrent problem anybody working in commodities faces, right? And you will see what I mean by that, right? So you can sort of say, okay, the price of the forward is the expected spot condition on the filtration at time little t, the information you have until then, and you can write it in closed form. And I think Eduardo used this to price gold and things and whatever. The one thing I dislike quite a bit about this, but it's very difficult to move away from, is anytime you see a forward contract like this for a commodity, you need to ask yourself, what happens if t is very large? Yeah? So if t is very large, that thing goes to 0. That thing goes to 0, so that survives in there. And that goes to 0. So very early on, this mean reversion, kills any movement in the forward curve, which is not quite right. So there's, again, the funny thing is I've been involved in this literature for quite a while, unfortunately, right? I would like to say that I took my PhD not too long ago, but it's not the case. So when you look at how the literature started looking at this, two sets of, two groups of paper are the ones that are moving forward. So some start by looking at the spot, and watch out, spot is kind of a bad word for what it really means. It's the shortest term contract you can find in the market, so we call it the spot. So you build a spot model, and that spot model, is used to then price forwards if you want. But again, it all depends what you want to do it. If you want to do some management risk and hedge sort of some risk or exposure to the spot market, that's the way to go. If you want to think more about the forward market, this is not the right way to do it, because you start from the spot, you capture perhaps the stylized facts of what the spot price is doing in the market, but the moment you price it forward, you will always see that this mean reversing nature that I talked about in the commodities that you observe in the spot, then puts the forward contract in a straitjacket. Very early on, there's, the forward is just a straight line or something which doesn't move. And it's not true, right? It's very, of course, you have, the spot will come in there, so we'll give it a little bit of movement as you move along, but it's actually not the best of the things. But well, so a further refinement to sort of this simple model that Eduardo wrote a while ago is convenience yield models. I think this is the Gibson-Schwarz, okay, which turn out to be over-parameterized, in fact. So watch out if you use this sort of model. I'll tell you, you can do the same thing with one fewer parameter. So this is an interesting one because they say, okay, let me start with a geometric Brownian motion as usual. Okay, of course, this again misses a little bit of long-term trends and so on, but I'll get to that later. That is, that is an easy thing to fix. But of course, there is this convenience yield, which remember is the benefits from holding it and the net of the costs of carry. And then they say, well, these things are, that is also a factor. Convenience yield is also jumping about. So that's why I call it kind of a fudge factor, right? It's telling you, okay, are the cost of carrying this thing, is it jumping around by a lot? Well, maybe not. Is it the convenience I derive from holding the spot commodity jumping around? Well, that's what this is saying. But, well, it might be the case. Or the cost as well. Again, remember, there's not an infinite supply of warehouses or storage for these commodities. So it is not mad to think that the cost of storing a commodity will change, because there's demand and supply for those, right? So having preempted all of that, an interesting question, so this is standard Brownian motions, and they're correlated. So a nice thing that you can observe is the following. You say, what sign of the correlation do we expect to pop out when you look at data? So if you ever work on these two, on the Gibson-Schwarz, a nice question after you calibrate the model to ask yourself, am I getting the right correlation of these Brownian motions? Right? And perhaps Brownian motion is not the best thing to use because, you normally observe lots of jumps, okay? But I'll refine it further on when I talk about power. So if you observe and you believe my story, everybody's story, that commodities do tend to revert to a long-term mean, which is given by the production costs of that commodity, let's say, or the storage costs, or, there has to be some sort of long-term prices to which demand and supply converge, right? So I don't see any mean reversion here. If you compare it to this one, there was some sort of mean reversion. Of course, there was just bringing you back to this, forcing this to a level. Here I don't see it immediately, but if you say, well, these two are correlated, these two Brownian motions are correlated, and let's think a little bit. If they are negatively correlated, what does it mean? Then when the shocks to the stock, to the price of the commodity, when the shocks are positive, right, and the correlation between these two is positive, means that when you see the stock price being shocked up or being pushed up by the increments of the Brownian motion or the Brownian shocks, but those are positively correlated. On average, you will also see the convenience yield going up, but that is subtracting from the drift. So you do catch, okay, in a very nice and subtle way, mean reversion in here by observing correlation. That reminds me a lot to the, if you've worked with this sort of Heston model or a volatility model where you correlate the stochastic vol shocks to the shocks in the equity, you see this negative leverage. But here, if anything, you might expect these to be positive, right? If I got my signs right. Well, it doesn't mean that it will always be like that, but all I'm saying is you do observe mean reversion here. That it cannot stray too far up or down. Okay? Perhaps what is not well defined here is what is a long-term level at which you want to you'll end up going. So again, if you were to price forward contracts, here you should, I can adjust, risk adjusted or risk adjust. There's a few nice papers later on that build on this by Jaime Casasus and Pierre-Colin Dufresne, which they take this model quite far. And then, you turn the crank and price stuff. So all I've shown you there is a very simple one of the earlier ones. Then the Gibson-Schwarz, and I think that applied it to oil. Okay? And then I want to move to electricity, which is a completely different beast and kind of magnifies all of these weird effects and jumps and so on that you would see in oil, you would see in gas. No, I haven't worked much with, sort of agriculturals. Those are more, I think they're sort of not as wild as a beast like electricity. So again, we've already commented on this, which is there's a few players here in all of these commodity markets. We see it in oil, right? The OPEC meets and they do something. So it's much more difficult to sort of move demand and supply in equity markets than you would do here. So the one thing, again, I'm very used to the British and the European sort of setup of how power markets work. I'm not sure how it works in Brazil, but this is an important, thing, which is you need to understand the structure of the market before writing a model. Those of you who like equity modeling and are interested in the limit order book and so on, well, depending how you trade it, where you trade it, the exchange where you trade the equity, how many exchanges trade that equity, the type of orders that are used in that exchange, you have to bear those in mind if you want to do the microstructure of equity modeling. In power, you need to understand the structure of the market itself. Okay, so think of European markets a long time ago, in the 70s, 80s, and so on, when they're all, they were not liberalized. These markets were, all plants were owned by the government. The whole, the production, the generation, the transmission, all of that was owned by the government. So it was very difficult to see prices. The moment you liberalize these markets, and the way you liberalize these markets will affect the power prices you see. Clearly, again, demand and supply will sort of pick up information that is given by the market, and if the market is efficient, well, prices will say, well, okay, this is too expensive. Let's build more plants. And that is a long-scale problem, but an important one in Europe, which is, okay, electricity prices seem to be going up, let's build plants. And then someone says, okay, but we can't really be burning coal anymore. That's too dirty. Okay, let's build gas plants, which is not as dirty. So you start doing this. And then someone raises their hand, well, but we need to meet renewable targets. So we have to have more wind farms. Okay, let's have some of those. So all of those decisions may be political or may be reflecting the true costs and externalities of producing electricity, but ultimately will define the dynamics of power prices. So look at, so I have a simple picture here, which is you can generate, I don't have many renewables here, right? But I do have a river. Okay, there's some coal, there's some nuclear, right? Which is very, do we have any nuclear plants in Brazil? Yeah? Okay. So what does this mean? I don't know what this one is. You need to put fires out, right? Well, then you generate, then you transmit, right? You have kind of a network, and then some, goes through all of the network onto a supplier, and then goes to you. So in the UK, the way the market was split up was very interesting. And it's like, not every single country has followed that. But in the UK, when they liberalized markets, they introduced competition at 3 important levels. 1, generation, transmission, and suppliers. Okay? So they had kind of a monopoly that was broken into 3 pieces. Okay? And one of the things you will see is power, although this is being changed, the prices we pay are pretty much fixed for a few months. I don't know how often you renew your contract with your supplier, but we normally as households pay fixed prices to these guys, and these guys pay part of what they do floating to those guys. And that makes things quite dramatic, okay? If there is, again, also weather patterns are important. I'll talk a little bit about that later on, but if you are in the UK, or let's say New England in the US, electricity prices tend to be very high in the summer. And the big spikes are in the summer because when it gets too hot, people switch on ACs, electricity consumption goes through the roof, and power prices at this level jump. However, at this level they stay put, and that's one of the problems. We do not react as households to generation prices, okay? So let me draw one of the most important pictures that you always have to bear in mind if you are interested in power, in thinking about power. I'm going to draw this bit, okay? So what does that mean in terms of supply? So if you're looking at these guys who are producing electricity all of the time, so normally you call that the base load, which is a nuclear plant is like a massive ship that once you set it, you set the thing going, you can never stop it. So nuclear plants are very costly to put and very costly to decommission. And in between, it produces the energy at a very cheap price, so long as you don't sort of price in the externality like Fukushima, right? That is one of the problems with nuclear plants, which is it's very clean energy. Well, clean, how do you dispose of this sort of material later on? But let's think in a simple world where, I pay a lot of money up front, billions. These are alive plants, nuclear plants are alive for 20, 30, 40, 50 years. And then at the end of this, I decommission them at a kind of an uncertain cost. So that's a nice problem to solve, right? Because decommission costs are not clear, but I'm not going to get into that. The important thing is, once you switch that beast on, it just goes on and on and on and on, right? So I'm going to write here megawatts, right? And here I'm going to write prices. So if you look at the first part of the supply stack, this is how people call the supply curve, right? So the supply curve here says, I'm just going to give numbers. Let's say 20 euros per megawatt for a long time. I don't know, I don't want to write that, but the nuclear plants will always be there providing energy at a very cheap price. Okay? Then, again, I'm not up to speed with the entire technology, but the next technology, so after all, what I'm trying to get at, for those of you who have done economics, I just want to really get at the notion of the marginal price here, right? For an economist, this is a very simple, trivial thing, and for mathematicians as well, which is, once you sort of maximize profits or once things in equilibrium, the marginal price or the marginal cost is the one that ends up setting the price. So the marginal cost for these guys is pretty much zero, right? Every extra unit up until their capacity, they always produce it no matter what. So you see a very elastic supply of power. Then depending on coal prices or gas prices, right, you end up having those plants kick in, right? So at some point, coal and gas will kick in, but at a higher price, right? Yeah? And the important thing here is that it's nearly a kink, really. After that, okay, I'm not putting any wind power just yet. After that, you get what's called the peaking plants, which are plants that only operate if the market is very short of electricity, but they're super costly to run. And some peaking plants might only sort of be switched on a few times a year, but they make a killing, right? Because that can jump from 20 to 500, right? The prices could well be, today you're seeing power prices at 20 euros a megawatt or 30 euros, and then all of a sudden you see 500, yeah? The wind farms and so on, will be here, but those are more volatile, right? And, in the past we've seen more and more of these come online, okay? But so they would add a little bit of noise to the supply stack. So what is the important thing? That if you observe in equilibrium, most of the time demand will be, well, this is too long, but demand will be here, right? Okay? Or in the evening. But it might be here. And the point is that demand pretty much hovers around that kink. So what is the problem that you observe here? Well, if it turns up that in the UK you wake up and it's a very cold day, which is usually but it's whenever I see it's a cold day, well, higher than, colder than you expected it to be, demand seems, kind of jumps to the right. And those little jumps in demand really cause big jumps in power prices, because it's very inelastic, the supply curve here, right? And people don't really care. You see, so one of the problems really is that we don't really care. We have a fixed price, and when the market becomes very tight, because whatever reason jumps, you observe, huge jumps in prices. And that's a very important thing to always relate yourself back to, which is, demand and supply here are very important. You must never forget. So when you write an SDE for the power price, all you're writing is this crossing. But the noise around that crossing is quite, is considerable if you think about Apple, trading Apple shares or IBM shares. Because what I've drawn here is kind of, well, a supply curve, but it might be, this is good for 7 in the morning, but at 7 in the evening it might be different as well, right? And I've only said stuff about the demand curve, but how about if a plant breaks down, which does happen? Supply immediately shifts to the left until it's fixed, and then you see a price jump. So when you are in a market where you're hovering around this kink, any sort of small shock may send your prices really, really high up. Okay? So there's shocks that are foreseeable, or there's seasonal patterns. So the one thing that I have not spoken about is, well, not only is it important to think about the long-term costs of producing a commodity, but also the seasonal patterns play a big role. So if those models that Eduardo wrote at the beginning of his career, they all lack a very important thing, which is, and he knew it, right? But he made it simple. It was, well, there's a seasonal pattern. Electricity in the sort of northern hemisphere is more expensive in one season than in the other. The US, the summer is super expensive compared to the winter, and the UK is completely the opposite. The UK has no summer, right? So it's whether you had a very cold day or not, and the same happens with gas prices, and the same happens, and again, you start saying, well, but where is storage? If storage was in infinite supply, gas prices should never move. Yeah? So when you see gas prices, some seasons goes up and down, and they're all very predictable. But you know why? Well, because it's costly to store it. But there's a finite amount of storage capacity. In the US, you can go to a web page and you can see exactly what storage is doing, how much storage is left, and you can see prices reacting to the level of storage in there because storage works in two ways for gas, right? If it's very cheap, you take it in, right, and store it. And if it's very expensive, then you release it to the market. But there's a, there's a capacity. And that sends a signal to the market as to, do you want to build a storage capacity? Well, go ahead. These are lumpy investments. Again, you cannot think of storage as a continuum that you can add a little bit of storage with spending a little bit of money. If you decide to build a storage capacity, it's a lumpy investment that only if you know you're going to recover this will you actually do it. So prices have to be very high or seem as, expected to be high for a long time because of, very, very sort of, capacity is not enough for you to build one. And it's not an easy thing. I'll tell you a little bit more about that when I come onto a gas model. So this is very important. So whenever you think about power, you have to think about many things. And that's why I love this as a topic. And it's the following thing. So power, how does it get traded? But, the truth of the matter is I don't know. Every time, that's why I said you need a friend that you can always call and say, how does this thing actually happen? I don't understand it. It's very, very complicated. Because power you cannot store. So it is very difficult to agree on a price now. A spot market is impossible to have. Well, nearly impossible. So all of the trading gets done ahead of time. So some of the capacity, electricity generation capacity committed ahead of time, years out, or months out, or seasons out, or the day-ahead market. The day-ahead market is a very interesting one. Because normally, there's two things you need to bear in mind here. You normally trade today, you agree on prices, and you call that the spot market, but it's really a day-ahead market. You spot prices for today, but delivery is later on. But you normally trade, depending on the market you're in, every hour of the day. Okay? So that supply stack and all of this, you have, electricity from midnight to 1 in the morning is a less valuable commodity than electricity at 7 in the morning. So the pricing will vary depending on the hour you're trading. Okay? And it could well be that, these can be traded 24 hours in advance or only 12 hours in advance. In some markets, you can trade the quarter of the hour. Okay? So all of these things really, really are important. So when you see pictures of spot prices, it might be showing you the average of the 24, which is the ones, I don't know if I ended up putting in there. So people sometimes get the day-ahead market, which is the average. So it's not as, you have to watch out because the spikes normally happen in the peak time, right? So normally people call the peak times 7 in the morning to 7 in the afternoon, or depending on what the peak time of the country is, right? So again, this is an oldie, which I could, I have to go back to see if they have the similar sort of info, but just to show how the supply stack in the UK is built and how it's changed over time, and now it's changed a lot, right? So this is telling you how much, the fuel you use to generate electricity in the UK, right, for 96 and 2004. So coal is pretty much steady. Gas became very cheap, and then we ended up using a lot more. Nuclear, as I said, right, nuclear is very stable, right? You either stop the thing, and that's the end of it. Renewables, I'm sure there's a lot more. Hydro in the UK is not big. If I were to draw this in the Scandinavian countries, hydro would be a really sort of big component of it, right? I'm sure Brazil has a lot of hydro, right? Venezuela does. Well, Venezuela doesn't work these days, but you also have a lot of hydro, right? Most of it, yeah. So when you have hydro, that is the only time where you can think a little bit of a storage capacity for electricity, right? You have what is called pumped storage, which is if electricity is very cheap, you sort of pump water up, and then, when electricity is very expensive, you let the water flow and then generate electricity. But again, it's not a great proxy for, how much does it cost to store electricity, and it's also idiosyncratic. There's countries like the Scandinavians where there's a lot of storage, right? And, this is down to the minute detail. If you go to a trader or talk to someone in Scandinavia, they'll show you every single storage in the whole of Scandinavia, how much water is there resting in case they need it, right? So people spend a lot of money to understand exactly the generation capacity there is to do this. Let me go back the picture again. So how does the transmission, so we spoke a little bit about this. We'll give you the supply stack. But again, that supply stack, for a given hour might look like this. There's plants that need to be stopped or cleaned and so on. So, those are previsible changes. So in the UK, there is a web page that tells you exactly how much electricity will be generated over the next 52 weeks, right? So there's a lot of info because it's a very expensive thing to get wrong. So the transmission part of it is quite important because these guys are in charge of balancing the market. Okay? So you need to ask yourself, how the hell does this happen, right? How do I know I have to switch on a peaking plant? It'll take me a little while. Some of these, the ramp up and ramp down of the gas plants is not immediate. So you might have some plants where, you can ramp them up, produce a little bit more, but it's not an immediate thing that you switch on. So a real options interesting problem is how would you value a plant that can do both coal, oil, and gas, for example? And, but there you really have to get into the switching costs and the time lead for you to be able to switch between one and another. So these guys are trying to get to have the balance in the market work properly by pulling in from generators and meeting demand, okay? So if there's a shortage or a previsible shortage over the next half hour, a couple of hours, they have to call on the rest. So these guys always have to be supplying info about how much idle capacity they still have, and they do it over the next, they give information for the next few hours, the next few days, and the next 51 weeks. That's normally how they do it, and so on, right? This is probably a dated one, but tells you a little bit about how the stack in the UK is formed. This is an old one. I'm sure it's changed a lot, but there you can see, a country where a lot of it is nuclear will be very cheap, right? So there's also an interesting question that I've never seen anybody treat, but it's kind of the question that I always said, why isn't the government in the UK or anywhere paying academics to answer this question? What is the socially optimal park? Okay, by park I mean, the industry there. What is, how much of what do you need? Of course, there's no right answer to this. If you want to be in a country which is all renewables and very clean, well, it's all wind farms. But you clearly cannot have that because you need to guarantee some minimum amount of power being generated every day. So depending, of course, on your objective function, there has to be an answer. What is acceptable in terms of dirty energy? What is acceptable in terms of volatility of prices? And that should drive a combination of how you end up producing power. That is a question that I think any politician should be able to answer, but it would require people like us and a lot of thought put into it in terms of, okay, you tell me how volatile you want the market to be. If you don't want any volatility around power prices, well, you have to do a lot of the stuff you might not like. Right? If you want not as volatile, a little bit of volatility, but not clean, well, you have to have more CCGT plants, right? Which are combined cycle, and you can have gas and coal, right? So, but it's not clear, right? It really is not clear, but it's an important question because they'll define, how volatile the market is and give you security of supply, which is a very important problem, right? You don't want to have blackouts. Venezuela, lately, everybody knows that at least 4 hours a day you don't have electricity, right? It's as simple as that. They just shut bits of the country down because there's not enough generation capacity. Okay? Okay, so I have 10 more minutes, right? Okay. So let's see what characteristics do I want to pick up. Then, so what do I want to move on to? I want to sort of say, okay, let's write now a model for electricity prices, right? Let's try and write something that makes sense and it's tractable. And again, if spot is what you're interested in, because you want to manage your exposure to risk in the spot market and so on, then you have to start with a spot model. If your interest is The forward market, then you have to write some of HAM sort of approach. I'm going to go mostly on the spot. Okay, but let me comment on the forward, which is the one I'm not saying much about. Why is it important? Imagine that you are a big electricity company and you're the CFO or the CEO of this company. And when you are a power company, you have assets that are going to pretty much be there for a long time, most of the time. Okay, 30, 40, 50-year assets. Unless they change, you know, like after Fukushima, Angela Merkel in Germany said, well, no nuclear, and they got a lot of people into a lot of trouble because you have stranded asset problem immediately, right? You have an asset, if it's a nuclear plant that you want to recover the cost over the next 40 years, but they change the rules, then you have to sort of, you have a sunk investment and you can't recover it. But let's put that aside. But imagine you are a big generation company, like British Gas or RWE or E.ON, I don't know the names down here. Perhaps you have the Spanish companies here, right? But you have to ask yourself, well, and I'll treat that in the equilibrium part of the talk at the end of, you know, after lunch, of course. How much power do you want to sell forward to guarantee some minimum cash? And that is a question, again, that the literature, in my view, has overlooked. So imagine you can produce 100 megawatts, let's just say, but, you know, 100 of something, electricity, every day for the next 50 years. And you need to have a view on how much do you commit of that forward and how much you want to sell in the spot market. I'll do the sort of static model later on where I come back to this question. But it's not trivial, right? Because you know generation is not 100% for certain. You know, plants do break down. So if you commit too much of it forward, then you might be in trouble. But if you want to do all of that, what you need is a forward model. Because I cannot write a spot model with a mean reversion that I normally see, but once I go from there onto forward prices, they become, you know, they're in a straitjacket. They don't move enough to give you any sort of reasonable model for what you should be doing, you know, between 1 and 10 years out, let's say. And again, at least in some companies in Germany do tell you the sort of portfolio of forward commitments they have over the long term, which is kind of an interesting thing, right? Do you want to commit 50% of your capacity 10 years out? And when time goes by, you're going to sort of roll those contracts, you know, buy them back, or you want to put back in the market. So I'm not saying much about that, but happy to discuss. If I showed you, and I had some pictures, but I just, for some reason, deleted it. If I showed you the day-ahead market in power, let's say the UK, let's say that is pretty much 20 megawatt, and let's say that's something like 150 pounds per megawatt. Pounds per megawatt, which is pretty much the same as euro these days, unfortunately, right? And this is time. And I show you, I don't know, let's show you a peak time. You know, you can have something like this. Okay? And it's incredible the number of jumps you see across time. And this could be, I don't know, 2 months, you know? So the spikes in electricity are huge. You know, there's some countries that cap to $1,000. I think Australia has a cap to $1,000 or $5,000 maximum. You know, you're not allowed to go beyond that. If you look at New England, again, you see prices spiking, going through the roof. You also observe this. Okay? It is not uncommon to observe power prices be negative. Because if you have too much, you have to pay someone either to take it from you or to put it down the ground. Okay, so all of these exponential models in electricity are kind of, well, why do you do that? I'm not going to be talking about additive models, but, you know, Fred Espenbent, I know you know Fred, you know, he's written, so he said one day, again, many years ago, he said, well, why do I want exponential models? Let's write an additive model. And we were like, yeah, well, why didn't I do that, right? Okay, so you can observe this in power. You can observe this in gas. Okay? Sometimes they pay you money to take gas. It's like going to the supermarket and they pay you to take stuff away. All right? So, of course, it's not a very common thing, but it does happen. Here it is clear that there's no storage, and if you have to get rid of it, you might have to pay to put it down the ground. Okay? So never shy away from an additive model. If I had to do all of these things over again, I would just do additive models, right? I'm going to show you one of the first papers I wrote. I wrote by saying, okay, let's do this. And I like to show this paper because it's one of the early ones. And as soon as we wrote it, we said, oh, God, this is all wrong, right? Well, not wrong, but we could have done it much better in a simpler way. And I'll tell you in a minute. So, again, what type of model? I'm stressing this a lot because, depending what your objective is, you want to do spot modeling. Okay, if it's short-term risk management or understanding the short-term behavior of prices and electricity, okay, that you want to write a spot model. If it's something a bit more longer term, you probably want to sort of write a forward model immediately. Okay, so I did have so this is an old one, but there you are. So I want to this just to have a contrast, right? People. I remember again when I started doing my MSc and PhD and all of this stuff. Everybody we were all very sort of into the equity modeling, and this thing about Gaussian shocks is no good. It is really bad model because Gaussian shocks or Brownian motion would never pick up the sudden movements you see in equity prices. Look at that. A Brownian motion could never give you that drop or that spike. And then we spend a lot of time with fat tail distributions and stochastic vol. And so alongside, you have something which really is a nightmare, right? So not only do you see massive spikes, but you also have the seasonal component, right? And if I were to draw the next 10 years from there, you will have something very similar. And this is the average of 24 hours in the day-ahead market. So imagine for us, I cut the picture here. But to go all the way that was an hour or two that went through the roof and even averaged out by 24, it stayed there. Right? And those are real prices. Okay? These were prices that people had to pay, retailers had to pay in the wholesale balancing market in the UK. Right? So this is megawatts per hour. Again, the average of every single hour. So what do I see which I think is important? Well, is the seasonal component. Okay, which is kind of, you think of it as always being predictable, which in fact it isn't, okay? But the massive spike. So I want to write a model that does all of that. So if I look at the previous ones where I showed you what Eduardo had written, well, that really doesn't fit the bill, right? So, but before that, again, if I look at a normality test of the FTSE 100, which is the equivalent of, kind of the S&P, but the sort of 100 blue chip companies in the UK, that QQ plot tells me that I need fat tails and, even fatter for a spot, so I don't even have to convince you of that. So let me start here, and then we can break for coffee. So what did we say? So we published this in 2005, and I don't want to sell my own stuff, but I'm going to sell it in a way that I'll highlight all of the things that were not right. And as soon as we had finished the paper, we said, but it's the sort of thing you say, well, I don't want to rewrite a paper that I don't even know if it's going to get published, right? There's a working version, say, well, we could have done this better, and so on. But remember, when we wrote this, nobody in the market knew that a forward in electricity had a delivery period, for example. So that's when they gave me data, I plotted, and I said, this is wrong. So we asked for the data again, or the data are wrong. And then I had a friend who worked in, with power, and he said, what's wrong? I said, listen, this is all straight lines. I said, what do you mean? Well, you're giving me forwards expiring, in a month's time and 2 months' time. So what I had been given was monthly forwards for the next 12 months. So, let's say you're 1st of January, I had the monthly forward start in for Feb, but of course, they were delivering electricity over a whole month. So when they quote you a forward price, what they're telling you is, this is how much you have to pay me to give you a megawatt at 7 in the morning, between 7 and 8 every morning, the whole month of Jan, and the whole month of Feb. So they give you a price. So what you really get is the average price But of course, I was expecting to see something different. So at the time, we were just trying to understand what the hell was going on in this market. So we said, okay, let's write a model for log spot prices that have a seasonal component. So one thing we said, okay, there's no way you can write the model with no seasonal component, right? So we say, okay, let's assume that that is a deterministic component, which really isn't. Okay, you can't really know now in advance what the sort of, you know there's a seasonal component, but it's very difficult to really get it right. And you'll see that we'll have again the forward problem, and then some sort of shocks, and we said, okay, I showed you a picture like that. Of course, we did a log model, so that couldn't happen. You know, we did an exponential model, but we said, okay, let's capture the jumps up. So, well, and we had read, you know, Merton's jump diffusion model. And you said, well, you know, we have it all there, right? Why am I going to do a lot of work when I can have some sort of Gaussian shocks? Volatility, yes. If you look at vol, it's also clear that volatility of prices is different across different seasons. Why? Because that, you know, the movements in demand are different in January than in June in the UK. Okay? These are kind of seasonal. There's more idle capacity in the winter for electricity in New England, okay, in Pennsylvania, Vermont, and so on. So you see a lot of jittery stuff going on in some sort of months of the year. So we sort of say, okay, we need to have that. So we have some Brownian component. And of course, you know, it is impossible not to have these jumps. Okay? And clearly, these are mean reverting to zero, right? So that's why we wrote it like this. So that was already a massive, you know, we massively overlooked how I should have written this. Okay, so I have 1 minute. So you know, as soon as we wrote the paper, we left it like this. It's not that it's wrong, but if you really want to do this properly, you need to write a model. We should have written something like that if we wanted an exponential model, right? If you do it if you do it like this, it would still hold. So you might want to have some seasonal component. But here, we should have had two factors. One that perhaps has all of the funny thing with the Brownian component, mean reverting at a given speed to zero, and a OU type component, okay, but whatever jumps, right? I was a bit sloppy the way I wrote it here, right? So what is the problem here? That when you calibrate such a model to data, the mean reversion I'm assuming there is bringing all the shocks down to zero at this exponential speed, right? But clearly, when you look at these prices, these huge spikes normally mean revert within a day. Okay? It'll be uncommon to see a massive spike like that survive for more than 2 days. So that could be a cold snap, that could be a plant that didn't work. Okay? So I imagine if a plant breaks down and this shifts to the right, then you see a massive shock. But normally 1 or 2 days. So if you ask yourself, when you look at the data, you say, oh, fine, I have the thing done. But you simulate data, you will find yourself that your estimation of that speed of mean reversion is compromising, bringing those jumps back very quickly. But those don't need to be brought down that quickly. Gaussian shocks, those tiny variations across days when there's no jumps don't need to be brought back at a super high speed. Okay? If you were to write it like this, of course, you have one more parameter in here, which is the speed at which the Gaussian shocks are sort of killed, right, or brought back to zero, right? Remember, I have the seasonal component and the jump. So, we could have written exactly the same paper in a nicer way, but, it doesn't matter. So I'll stop there, right? And we come back at 12. I'll be very happy to take questions over the coffee break.
Yes. Okay, well, since we are at about time to have a break, as